Hi folks, today I'm going to talk about REITs or real estate investment trusts. Essentially, individual investors are interested because this gives us an opportunity to get into the commercial real estate space without having actually to buy or manage these properties. So, REITs, to summarize quickly, are vehicles which own real estate that yields some sort of rentals like office spaces or malls. Like mutual fund schemes, the REIT pools money from investors and invests into these assets. They are mandated to generate and give back a large portion of the income to the respective shareholders. So, I'm not getting into more detail about the structure of REITs, but let's move to the numbers that Indian REITs have delivered. So I've taken the data from Brookfield REIT, Embassy, Mindspace, and Nexus. Here I'm going to first take you through the basic calculation. So I've taken the data from Brookfield REIT. I've assumed that I'm a unit holder who has got allotment during the IPO. So the IPO date was 2021. The investment I put in was 5,50,000. The price per unit at that time was 275 rupees. So the number of units I got issued was 2000. Now, all this dividend data was available on the website of each of these REITs. So that was quite reassuring to see that all the data is there, it's quite transparent, etc. So now let's look at it. So now, if I look at the returns that I get from the REIT, there are four types. The three highlighted here are interest, dividend, and interest on fixed deposits. There's also a fourth component, which is the return on shareholder loan. So I have taken the top three components as returns that I'm getting as an investor, whereas the repayment of shareholder loan is treated as a reduction of my cost of capital. Therefore, whatever returns I get will be better because my cost of capital is going down over the years. Now, the per unit return that I got is roughly about 5 rupees in the first quarter, 4 in the second quarter, 3 in the third quarter, and 3 again in the third quarter. I didn't get any dividend or interest on fixed deposit. Therefore, my total returns for the year 2021-22 is 15. And this multiplied into the number of units, which is 2000, gave me a total return of 31,000. Now, as you remember, I had invested 5,50,000, but I got a return or I got a repayment on the loan of 2 rupees. Therefore, I got 13,000 rupees back as my return. So now my capital after repayment is 5,36,000. If I do a simple calculation of the amount I got over the capital deployed, it is 5.75%. This was the return I got for the first year. Now, as I mentioned earlier, it is a simple calculation. If I have to do exact calculations, then the return may vary. But to get a broad idea of how the REIT returns work, this should suffice. In the next year, my repayment, my returns are a little lower compared to the first year where I got 15 rupees per unit, I got 10 rupees per unit. Therefore, my returns came down a bit and my repayment, my capital further came down because I got another 20,000 rupees back. So but even then, my return was only 3.8%. If I look at the next year, it's 3.46%, and the year which concluded now is 4.11%. So this is one part, the return that we are getting on the investment that we have made on a yearly basis. There's also another return which is notional until you sell the units. So you have, for the IPO, I had put in 5,50,000 rupees, correct, at the price of 275. Now this price can go up and down. So the unit price at that time was 275. The next year it went to 313 rupees. So my appreciation for that year was 11.88%. This is the annualized return that I've taken. Now, why I say that it is notional? Because I didn't sell it at that time. I'm still holding on to it. So till I don't sell it, it's not real, but it's good to calculate and know how the Unit price is benefiting us should I sell at any point of time. The next year, the unit price dropped to 279. So I barely made any money. And this trend sort of continued. It became 254 and then it is 289. So while the units are easily liquidatable, it doesn't mean that you might get the price or the appreciation that you're looking for. Just like equity shares, this has the same risk of capital depreciation also. Now, I have tabulated all these returns here. So if you see, I have compared for Brookfield, Embassy, Mindspace and Nexus. I've done the same sort of analysis for this and I have put the results here. So Brookfield came out in 2021, Embassy came out before that 2019, the Mindspace REIT came out in 2020 and the Nexus REIT is the youngest among this which we have only 2-year data. So if you look at the distribution of return, if I just take a very simple average, here I'm getting 4.28% from Brookfield across the years. Here I'm getting 4.88%. So not very exciting either of these returns, lower than FD if you look at it. The Mindspace REIT has given me slightly higher returns, which is 6.38%. The Embassy REIT, the Nexus REIT has generated higher returns, but it's only 2-year data. So is it too early to judge? We have to look at that part. Now for each of these, the unit returns have also, the unit prices have also moved up and down. So if we look at that here, the Nexus REIT has scored the best, which is 37% in the first year and 15%. The Mindspace REIT has done overall decent. It's at 6.79% currently, whereas the Embassy and Brookfield REITs are lagging at the end of 2025. The prices would have changed now. I'm not factored that in, but we can get an idea with this. So now when you look at all these points, you can get an idea of the returns. One important thing is to understand the taxation of the REITs as well. So when the dividend income is given to us, the dividend income is exempt in the hand of unit holders. This is because the REIT pays the tax. But if the REIT does not pay, or rather, if the REIT pays tax under section 115BA, the note at the bottom, then we as receivers of that dividend still have to pay tax. And how do you figure this out? So I just did a quick search for Mindspace and I saw that they have mentioned on their website that no tax is deductible because they have not opted for the beneficial tax regime. So this gives us the advantage. We don't have to pay tax on the dividend. This is as of now. At the time of investment and redemption, please look into this before you go ahead. Whatever interest income and other income, like we saw interest on fixed deposit, these are taxable. So it will be added back to our income and we are taxed at our tax slab. The capital repayment is treated as a return of capital. Therefore, there is no tax on this. As we saw earlier, the repayment of shareholder loan be reduced from our capital as we go along. And the sale of units, if you're familiar with the sale of equity mutual funds and the shares themselves, then the long-term capital gains is considered after you hold it for a period of 1 year. The gains are taxed after 1.25 lakhs. So up to 1.25 lakhs gains is not taxable, but after that it is taxable at 12.5%. Of course, we have to remember that all the gains, equity-oriented mutual funds, REITs, etc., for that financial year will be put under this 1.25 lakhs bracket. Anything above that will be taxed. And if it is short-term capital gains, then the holding period is less than 1 year and your gains are taxed at 20%. So to summarize, let's look at the positives and negatives of REITs. Essentially, we get diversification by getting into real estate backed assets. There are stable quarterly payouts, which we have seen, though in this case they've been slightly declining. There's liquidity. Unlike physical properties, both residential and commercial take a lot of time to liquidate. Here we can get onto the exchange and we can sell it, the units that is. Accessibility, with relatively smaller capital, we are able to invest into these assets. and they are managed by professional managers. So we get that benefit as well rather than you and me managing it ourselves. The negatives are that the underlying risks are there, of course. There is vacancy, tenancy defaults, lower renewals. These all can affect cash flows. The limited growth potential is there because most of the income which we are getting is the, the most of the income is the REIT is getting is distributed to us. Therefore, they cannot reinvest it, leaving limited growth potential. REIT prices are very sensitive to interest rates, so we have to be careful of that. All this makes it a bit tricky to understand and know how the movements of various things would impact. So, economic movement, preference, geographical preference of maybe MNC companies, the interest rate movements, all this may affect in a way that you and me as retail investors may not be able to understand. So, we have to be careful. It's overall I found the product a bit complex because when I started doing the analysis, it took me so long to understand the structure and to put it down. I almost gave up, but then I thought that mutual funds also was complex to me when I started, but slowly over time I understood. But it could be difficult for a retail investor to track the returns that they are getting, so this can be frustrating. So for example, the loan payment, the loan repayment that we are getting also comes in the form of return. So how does it affect? This was a bit difficult to understand. And tax complexity is there. We need to split the multiple components. Then we need to account for each of them. So given this complexities, it is necessary for retail investors to study this, maybe track it for a few quarters, see if you are excited by it, see whether you fully understand it, and then put your investments into the product. So if you have any more queries, please do drop a comment or get in touch with us on our contact points. We'll be happy to get back to you. Thanks for watching.